Welcome back. In Part 3, we dive into the world of Forex economic theories. From classical ideas like purchasing power parity and interest rate parity to modern models of overshooting and open economy dynamics, this section reveals the intellectual frameworks that explain how currencies move and challenges the question of whether markets are truly efficient. Part 3, Forex economic theories. Chapter 7. Classical exchange rate theories. Purchasing power parity, PPP. Interest rate parity, IRP. Fisher effect. Limitations and empirical failures. Chapter 8. Modern exchange rate models. Monetary models. Portfolio balance approach. Dornbusch overshooting model. New open economy macroeconomics. Chapter 9. Market efficiency in Forex markets. Efficient market hypothesis. Weak, semi-strong, strong forms. Empirical evidence for/against efficiency. Chapter 7. Classical exchange rate theories. Classical exchange rate theories form the intellectual foundation of modern foreign exchange economics. These models attempt to explain how exchange rates are determined based on prices, interest rates, and macroeconomic fundamentals. Although widely taught and extensively researched, empirical evidence shows that these theories often perform poorly in short-term forecasting, creating one of the central puzzles in international finance. 7.1 Purchasing Power Parity, PPP. 7.1.1 Concept and Origins. Purchasing power parity is one of the oldest and most influential exchange rate theories. Its origins can be traced to the law of one price, which states that identical goods should sell for the same price across countries when expressed in a common currency. PPP suggests that exchange rates adjust to equalize the purchasing power of different currencies. There are two main forms. Absolute PPP, exchange rate equals the ratio of price levels between two countries. Relative PPP, exchange rate changes reflect inflation differentials over time. 7.1.2 Empirical evidence on PPP. Academic research provides mixed evidence. Long-run studies, Rogoff, 1996, show that PPP tends to hold over very long horizons, 5 to 10 years or more. Short-run deviations from PPP are persistent and substantial. Price rigidities, transportation costs, tariffs, and non-tradable goods weaken PPP validity. Empirical findings suggest that real exchange rates mean revert, but extremely slowly, a phenomenon known as the PPP puzzle. 7.1.3 Limitations of PPP. Key limitations identified in research. Goods baskets differ across countries. Services are largely non-tradable. Market segmentation and pricing power distort prices. Capital flows dominate trade flows in modern FX markets. As a result, PPP is considered a long-run anchor, not a short-term pricing model. 7.2 Interest rate parity, IRP. 7.2.1 Covered interest rate parity, CIRP. Covered interest rate parity states that interest rate differentials between two countries are offset by forward exchange rates. Mathematically, forward premium is almost equal to interest rate differential. Empirical research finds that CIRP holds extremely well in developed markets under normal conditions. Deviations are rare and usually reflect transaction costs, capital controls, counterparty risk. During financial crises, CIRP breakdowns have been observed, highlighting the role of credit risk and funding constraints. 7.2.2 Uncovered interest rate parity, URP. URP suggests that expected exchange rate changes offset interest rate differentials without hedging. However, empirical studies consistently find that high interest rate currencies tend to appreciate, not depreciate. Low interest rate currencies tend to depreciate, not appreciate. This contradiction is known as the forward premium puzzle, one of the most robust anomalies in FX research. 7.3 The International Fisher Effect. The Fisher effect links interest rates to expected inflation. The International Fisher Effect, IFE, extends this logic across countries. Exchange rate changes reflect differences in nominal interest rates caused by inflation expectations. Empirical evidence shows that IFE holds weakly in the long run. Short-term deviations are large and persistent. Monetary policy credibility strongly affects outcomes. Thus, like PPP, the IFI is more useful as a theoretical benchmark than a forecasting tool. 7.4 Monetary models of exchange rates. Monetary models integrate money supply, income, and interest rates to determine exchange rates. Core assumptions. Money market equilibrium. PPP holds continuously. Rational expectations. Research finds that monetary models perform poorly in short horizons. They regain explanatory power in very long-run datasets. The failure of these models to outperform a random walk led to widespread skepticism. 7.5 The Mies-Rogoff Puzzle. In a landmark study, Mies and Rogoff, 1983, demonstrated that no structural exchange rate model consistently outperforms a random walk in short-term forecasting. This result reshaped international finance research and remains relevant decades later. Subsequent studies confirm that macro fundamentals matter, but with long and variable lags. Expectations, risk premiums, and order flow dominate short-run movements. 7.6 Why classical theories fail in practice. Research identifies several structural reasons. Capital flows exceed trade flows by orders of magnitude. Financial markets react faster than goods markets. Expectations and speculation dominate pricing. Institutional behavior and market microstructure matter. These findings suggest that exchange rates are asset prices, not simple relative prices of goods. 7.7 Key research takeaways. Classical theories provide long-run anchors, not short-term forecasts. PPP and IFI explain equilibrium tendencies, not daily movements. Interest rate parity holds in hedged markets, but fails unhedged. Empirical puzzles remain central to FX research. Modern models must incorporate expectations, risk, and market structure. References. Mies, R. and Rogoff, K. 1983. Empirical Exchange Rate Models of the 70s. Journal of International Economics. Rogoff, K. 1996. The Purchasing Power Parity Puzzle. Journal of Economic Literature. Engel, C. 2016. Exchange Rates, Interest Rates, and the Risk Premium. American Economic Review. Obstfeld, M. and Rogoff, K. 1996. Foundations of International Macroeconomics. MIT Press. Fruit, K. and Thaler, R. 1990. Anomalies. Foreign Exchange. Journal of Economic Perspectives. Chapter 8. Modern Exchange Rate Models. The persistent failure of classical exchange rate theories to explain short-term currency movements led to the development of modern exchange rate models. These models treat exchange rates as financial asset prices, driven not only by macroeconomic fundamentals, but also by expectations, capital flows, risk premiums, and market imperfections. Academic research since the 1980s has increasingly emphasized these dynamics. 8.1 The Asset Market View of Exchange Rates. Modern theory begins with the premise that exchange rates behave like asset prices. They respond immediately to new information. Expectations about the future dominate current pricing. Capital mobility outweighs trade flows. According to this view, currencies are priced based on the expected return from holding one currency relative to another, adjusted for risk. 8.2 The Dornbusch overshooting model. 8.2.1 Core idea. Proposed by Rüdiger Dornbusch, 1976, this model explains why exchange rates can be excessively volatile in the short run. Key assumptions. Prices are sticky in the short run. Financial markets adjust instantly. Monetary policy shocks affect interest rates immediately. 8.2.2 Overshooting mechanism. When a central bank expands the money supply, interest rates fall. Capital flows out. The currency depreciates sharply, overshoots. Over time, prices adjust and the currency partially recovers. Empirical research supports the existence of overshooting following monetary policy shocks, particularly in major currencies. 8.3 Portfolio balance models. Portfolio balance models extend monetary models by allowing investors to hold imperfectly substitutable assets. Key features. Investors care about risk and diversification. Government debt composition matters. Exchange rates adjust to equilibrate asset portfolios. Research indicates that large-scale asset purchases, QE, affect exchange rates through portfolio rebalancing. Risk premiums play a central role in FX pricing. These models gained renewed relevance after the 2008 financial crisis. 8.4 Risk premium and time-varying expectations. Modern empirical studies show that exchange rates include a risk premium. Investors demand compensation for holding risky currencies. Risk premiums vary over time. This helps explain failures of uncovered interest rate parity. High-yield currencies often offer positive excess returns, contradicting classical theory. This insight underpins the extensive literature on carry trades. 8.5 New Open Economy Macroeconomics, NOM. NOM models integrate micro foundations, sticky prices, imperfect competition, monetary policy rules. These models explain how policy shocks transmit internationally, why exchange rate pass-through is incomplete, why monetary policy has real effects in the short run. Despite their theoretical sophistication, empirical validation remains mixed. 8.6 Expectations, News, and Information Flow. Research demonstrates that exchange rates react strongly to macroeconomic announcements. Surprises matter more than actual data levels. News effects are strongest during high liquidity periods. However, macro news explains only a small fraction of daily FX volatility, reinforcing the role of expectations and order flow. 8.7 Limits of modern models. Despite improvements, modern models still face challenges. Limited out-of-sample forecasting power. Heavy reliance on unobservable expectations. Sensitivity to model assumptions. As a result, many researchers conclude that exchange rate determination remains partially unresolved. 8.8 Key research takeaways. Exchange rates behave like financial assets, not goods prices. Overshooting explains excess volatility after policy shocks. Risk premiums are central to FX pricing. Expectations dominate short-term movements. No model consistently beats a random walk in forecasting. References. Dornbusch, R. 1976. Expectations and Exchange Rate Dynamics. Journal of Political Economy. Engel, C. 2016. Exchange Rates, Interest Rates, and the Risk Premium. American Economic Review. Obstfeld, M. and Rogoff, K. 1995. Exchange Rate Dynamics Redux. Journal of Political Economy. Lyons, R. 2001. The Microstructure Approach to Exchange Rates. MIT Press. Bacchetta, P. and Van Winkoop, E. 2013. On the Unstable Relationship Between Exchange Rates and Fundamentals. Journal of International Economics. Chapter 9. Market Efficiency in Forex Markets. The question of whether foreign exchange markets are efficient lies at the core of international finance research. Given that FX markets are the largest and most liquid financial markets in the world, economists have long debated whether exchange rates fully reflect all available information or whether systematic inefficiencies persist. 9.1 The Efficient Market Hypothesis, EMH. The efficient market hypothesis, originally formalized by Eugene Fama, 1970, states that asset prices reflect all available information. In the context of Forex, EMH implies no trader can consistently earn abnormal returns. Exchange rate changes are unpredictable. Prices adjust instantaneously to new information. 9.2 Forms of Market Efficiency in FX. 9.2.1 Weak form efficiency. Past prices and returns cannot predict future exchange rates. Technical analysis should not yield consistent profits. Empirical findings. Most short-term FX returns resemble random walks. Autocorrelation is weak or unstable. 9.2.2 Semi-strong form efficiency. Prices reflect all publicly available information. Macroeconomic announcements are rapidly incorporated. Studies show FX markets react within seconds to major data releases. Any predictable patterns decay quickly. 9.2.3 Strong form efficiency. Prices reflect all public and private information. This form is widely rejected as central banks and large institutions may possess informational advantages. Order flow reveals private information before public release. 9.3 Random walk hypothesis and exchange rates. Mies and Rogoff, 1983, famously demonstrated that structural exchange rate models fail to outperform a random walk. Even with perfect hindsight, forecasting accuracy is poor. This result has been replicated across major currency pairs, multiple time horizons, different model specifications. As a result, the random walk benchmark remains dominant in FX forecasting research. 9.4 Empirical anomalies in Forex markets. Despite strong efficiency, several anomalies challenge EMH. 9.4.1 Forward premium puzzle. High interest rate currencies tend to appreciate rather than depreciate. Violates uncovered interest rate parity. This anomaly underpins extensive research on carry trade returns. 9.4.2 Momentum effects. Short to medium-term momentum has been documented, particularly strong over 1 to 12-month horizons. However, momentum profits decline after transaction costs. Returns are unstable over time. 9.4.3 Value effects. Currencies deviating from purchasing power parity tend to revert. Mean reversion occurs slowly, often over years. This supports long-horizon predictability but weak short-term forecasting. 9.5 Microstructure evidence against full efficiency. FX microstructure research reveals order flow contains private information. Exchange rates adjust gradually to trading pressure. Liquidity conditions affect price formation. Lyons, 2001, shows that order flow explains a significant portion of daily FX movements. Prices are not purely information-driven. This challenges the strongest interpretations of EMH. 9.6 Central bank intervention and efficiency. Research on intervention finds sterilized intervention can influence exchange rates temporarily. Signaling effects matter more than portfolio effects. Transparency alters market response. While not permanently destabilizing efficiency, intervention introduces short-term distortions. 9.7 Behavioral perspectives. Behavioral finance research suggests traders exhibit herding behavior. Overreaction and underreaction to news exist. Risk perceptions fluctuate irrationally. However, arbitrage capital limits persistence of inefficiencies. Behavioral effects are difficult to exploit systematically. 9.8 Reconciling efficiency with anomalies. Modern research concludes FX markets are highly efficient but not perfectly efficient. Predictability exists but is fragile. Excess returns often compensate for risk. Thus, observed anomalies do not necessarily imply free profits. 9.9 Key research conclusions. Forex markets are among the most efficient financial markets. Random walk remains a powerful benchmark. Some anomalies persist but lack stability. Microstructure evidence weakens strong form efficiency. Risk premiums explain much apparent predictability. References. Fama, E. 1970. Efficient Capital Markets. Journal of Finance. Mies, R. and Rogoff, K. 1983. Empirical Exchange Rate Models. Journal of International Economics. Lyons, R. 2001. The Microstructure Approach to Exchange Rates. MIT Press. Engel, C. 2014. Exchange Rates and Interest Parity. Annual Review of Economics. Burnside et al., 2011. Carry Trades and Risk. Review of Economic Studies.